Welcome to The Explainer. Today, we're diving deep into a really nasty compliance trap that trips up so many business owners and even their advisors. We're talking about how that single member LLC you have, the one that's basically invisible to the IRS, can suddenly trigger some pretty significant taxes and penalties at the state level. We're going to get into the weeds here, looking specifically at the rules in New York and California, and see how federal simplicity creates a world of state complexity.
So here's our game plan. First, we'll tackle the core misunderstanding, this whole disregarded entity idea. Then we'll zoom in on New York's system and its form IT-204-LL. After that, we'll head west to break down California's one-two punch of a franchise tax and the Form 568 fee. Then comes the scary part, comparing the penalties. And we'll wrap up with some real actionable strategies to keep you or your clients out of hot water.
All right, let's get right into it. This whole problem really starts with the federal check-the-box regulations, specifically Treasury Regulation Section 301.7701. Now, these rules are great. They give businesses a ton of flexibility on how they want to be taxed by the feds. But here's the kicker. That choice you make for the IRS, it does not, and I mean cannot, force the states to play along.
And that creates this tale of two completely different views. The IRS looks at your single member LLC and says, we don't see it. It's a ghost in the machine. Just report everything on your personal return. But then states like New York and California look at that same LLC and they see something totally different. They see a legal entity they created, one that gets liability protection and access to their market. And for that privilege, well, they're going to charge a toll.
So the bottom line is, for the IRS, everything is simple. All the LLC's activity just flows onto your personal Form 1040, maybe on a Schedule C. It's clean, it's elegant. But this leads so many people to think the LLC has no tax identity at all, anywhere. And that assumption right there is precisely where this beautiful federal simplicity ends and the state-level tax trap begins.
Let's start with our first case study, New York. The state's weapon of choice here is Form IT-204-LL. The full name is the Partnership Limited Liability Company and Limited Liability Partnership Filing Fee Payment Form. Just from the name, you can tell it's designed to cast a really wide net.
So who exactly gets snagged in this thing? This is the million-dollar question for anyone doing business in the state. And you might be surprised to find out that the threshold for getting caught is incredibly low. And, get this, it has almost nothing to do with whether or not your business actually made any money. Forget about profit. This is all about your presence and your gross receipts.
And this right here just demolishes what I call the net income myth. The law in New York is crystal clear. If your LLC has any, and I mean any, income, gain, loss, or deduction tied to New York, you have to file Form I-204-LL. So even if you had a terrible year and a net loss, it doesn't matter. You still have to file and you still have to pay at least the minimum $25 fee. Compare that to regular partnerships. They only have to file if they hit $1 million in gross income. This is aimed squarely at LLCs.
And here it is. This little phrase is the absolute core of the New York trap. The fee you owe is based on something called New York Source Gross Income, and the state defines that term as your revenue before you subtract the cost of the goods you sold. It's a pure top-line number. They don't care what it cost you to make the thing you sold. They're taking their cut right off the top.
So let's see how this plays out with real money. Imagine you have an e-commerce business that did $2 million in gross sales to customers in New York, but your margins are razor thin, and after costs and expenses, you actually lost money. Well, according to this table, too bad. You owe New York a $1,500 filing fee. The fee is completely 100% disconnected from your actual profitability.
Okay, now let's head west to California. Their system is different, and it's all detailed on Form 568, the Limited Liability Company Return of Income. If New York's trap is all about a tricky definition of income, California's is way more direct. It's basically a pay-to-play model. Just for the privilege of existing or doing business in the state, you're going to owe them money.
And this is the number you need to remember, $800. Under California's Revenue and Taxation Code Section 17941, pretty much every LLC that is organized, registered, or doing business in California has to pay this minimum franchise tax. And it doesn't matter if your LLC is active, profitable, or completely dormant. If it exists on paper in California, you owe them $800, period.
But wait, it's a one-two punch. That $800 is just to get in the door. That's part one. Then comes part two. Under Section 1742, you have to calculate and pay a separate LLC fee, and this one is based on your total income that's sourced to California. So, you have the flat tax, and then you have a variable fee on top of it. And as you can see, this fee is stacked right on top of that $800 franchise tax. So let's say your LLC brings in $5 million in California income. Your bill isn't just the $11,790. Nope, it's that fee plus the $800 you already owe, for a grand total of $12,590, all paid with Form 568.
So not filing and paying is obviously bad, but the consequences for not paying, that's where New York and California really go their separate ways. And this is where the trap really springs shut. Let me tell you, California's system is particularly brutal.
This chart really tells the story. You look at New York, and the penalties are what you might expect. Interest, percentages of what you owe, it's financial. But then you look at California, and they just start stacking penalties. You've got a late filing penalty per member per month. You've got late payment penalties. And then there's this massive penalty if you ignore a notice from the Franchise Tax Board. But believe it or not, the worst consequence isn't about money at all.
This is the knockout punch in California. It's called suspension of your entity's powers. The Franchise Tax Board can literally have your LLC's legal status suspended. Think about what that means. Your LLC becomes a ghost. It can't enforce a contract, it can't sue someone who owes it money, and maybe worst of all, it can't even defend itself in court if it gets sued. That corporate veil, the very reason you set up the LLC, poof, it's gone, all because of a missed tax filing.
Okay, so that was pretty scary. After hearing all that, the obvious question is, how do you avoid this nightmare? How can you protect your business? This isn't just about saving a few bucks on fees. It's about protecting the entire legal status of your company. So let's talk strategy. So one of the single best strategies is what's called a protective filing. Here's why it's so important. If you don't file a return, the statute of limitations, the time the state has to come after you, never starts. That means they could theoretically audit you 10, 15, 20 years from now. No joke. But by filing a return, even if it's just to pay the minimum $25 in New York or the $800 tax in California, you start the clock. You give the state 3 or 4 years to look at you, and after that, they can't. It is an absolutely crucial insurance policy against a huge future risk.
So, at the end of the day, the big question you have to ask is this. Is that disregarded LLC of yours really flying under the radar? The critical takeaway here is that choosing to be invisible for federal taxes does not make you invisible to the states. That idea of state immunity is a complete myth. You have to look at your business activities in every single state you touch, because being invisible in Washington, D.C. can make you a very, very visible and very lucrative target everywhere else.